have some guests in the studio this morning. I love having guests on Mid Mornings with Amy. We have Angie Brown and John Harville with Evans, Harville, Atwell and Company CPAs. Good morning.
Good morning.
To you.
Thank you all so much for being here. John, you said this is your return visit. You've been to the studio several years ago.
Yes, back in the good old days.
Angie, this is your first time.
It is.
Welcome. We are talking about taxes this morning because it is tax season, and it's still early in tax season, so a lot of people may not have filed taxes yet. So we want to make sure that for those of you who have not filed yet, you have some information that you need to know before you go see your accountant, and that's where you all come in this morning to give us some advice and some information. Let's start, John, by talking about some common mistakes that people make when they file their taxes, information they forget to bring with them to their accountant or things they fail to remember before filing their taxes.
Well, Amy, that list could be very long, so we'll try to narrow it down to some of the most common items that we see taking place on tax returns and information that we may have to make a call back to a client for. So some of the most common things you see on tax returns, this is more for people who are doing their own and what have you, but unbelievably, math miscalculations leads the list of items that don't go well for you on your tax return. And parenthetically, if you make these mistakes and you're depending on a tax refund to come in quickly, all of these are going to slow that down. So a lot of people these days do the direct deposit, which means you get your tax refund within usually a 10 business day window. So any of these are going to slow that down for you. And I have clients who like to get that in as quickly as possible, which is quite understandable. Secondly, one of the most common mistakes is computation errors. That is a little different than a math error. You carry something over from a schedule that comes onto your 1040 incorrectly, and you make the math error, and the first thing you're going to do is get a letter from the IRS. And I think they like to send those out because that slows down your refund, like we said. You want to make sure that everything is spelled correctly. Names need to match up with Social Security numbers. That's probably the biggest mistake we see. Somebody has a W-2 that comes in, they don't look at the W-2, and that W-2 has an incorrect Social Security number. And if we use that on the tax return and it gets submitted, today the IRS matches all those up. And if you don't have that nailed down, you're going to, again, have a delay and get a letter from the IRS saying that either you're not matching up or your dependents aren't allowable because that doesn't match up. So make sure you got your Social Security numbers and your name spelled right. And one of the biggest issues with that is when people get married. If you don't go, if the spouse does not go change their Social Security card, the name and the number do not match up anymore, and that automatically throws it out. So if you're newly married, have a child, make sure you get those Social Security numbers matching up with the names that are on the Social Security card. One item that we see very infrequently because we try very hard to make sure this doesn't happen, but if you are direct depositing and you put the wrong account number on the tax return for the direct deposit,
your money has nowhere to go.
Your money has nowhere to go, or it may go into someone else's account. So be very careful about making that number match. It's vital because the times that we've seen it happen, it can take a long time to get that straightened out.
And John, those seem like small things that if we take just a little bit of time to make sure that are correct, they won't happen and people can get their filings back quickly.
Absolutely. And your tax preparer will, particularly the ones that have been doing this a while, will try to help you through that. We've seen those mistakes, and we try to correct them so that the delays aren't there. But anytime you go to the mailbox, open it up, and there's a letter that says IRS on it, it's usually a bit unnerving. So these things will help you avoid having that type of morning. Couple other things that we see, again, making sure the Social Security numbers are right. Sometimes people have income that they forget about. They go do some yard work for somebody and they get paid. Sometimes a business will send them what's called a 1099. They don't think about that. A 1099 basically tells the IRS, hey, I've paid this person this much money, which means you need to pick that up on your income tax return. So if you don't have that turned in, again, another letter comes to you. Filing status errors, those are quite common these days. A lot of people don't actually know how they're supposed to file. Those are the type of things your tax preparer can help you with. If you file a paper return, which most people don't these days, but if you do file a paper return, make sure you sign the return. If there's no signature on it, they'll put it back in the mail, send it back to you, and then if you don't get it back to them before April the 15th, they can theoretically say your tax return was filed late. So make sure if you have a paper return that you sign it.
A lot of online filings now. And Angie, I know you all as accountants, and most accountants in general, you want to make sure that people's taxes are filed correctly and that they get as much money back as they possibly can. So what are some things that people do need to bring with them when they come to see you? Things they need to remember that they need to bring to their accountant?
Absolutely. Obviously, anything that's been issued to you on a government form, that seems a little simplistic, but some people forget that. If the W-2 that you receive at the end of the year from your employer, that's the most common one that anyone would have. Any 1099 that you receive, which is what John was talking about. So if you've taken money out of a retirement account, that retirement account will send you a 1099. Now, for example, if you have rolled that over into another qualified plan, then it's not going to be taxable to you, but they will still send you a 1099. Make sure you give that to your tax professional. What John was saying, if you, for example, if you mow yards for someone, they may give you a 1099 for that work. Make sure you turn those sorts of things in. A good idea is to always look at your go back and look at your tax return from the year before, and that will help sort of jog your memory. Oh, I may have given $100 to Bethany House in the prior year. Did I give them any donations this year? Or your Goodwill donations. Any expenses like medical expenses. Some people can deduct medical expenses. Be sure to round all those things up. If you have any interest that you paid on student loans, your student loan bank will send you a statement at the end of the year to let you know how much that amount is. Your banks will also send you 1099. So if you earned any interest income during the year, they'll send you a 1099 to let you know how much it is. And they'll also send you a 1099 to let you know how much mortgage interest you paid in that year, which is also deductible. So make sure you send all of those sorts of things to your tax professional.
We have a lot more to talk about this morning on Mid-Mornings with Amy, but we're going to take a quick break. We're talking with Angie Brown and John Harville with Evans, Harville, Atwell & Company CPAs. Welcome back to Mid-Mornings with Amy on Wednesday, February 12th. Still about 23 degrees in the Somerset area, and we are talking with Angie Brown and John Harville with Evans, Harville, Atwell & Company CPAs. And it is tax season, so if you haven't filed your taxes yet, you want to make sure to pay attention this morning to some things you might want to remember to think about before you go see your accountant. And John, let's talk about some tax laws and some deduction requirements that may have changed this year, that maybe people got last year, expected last year, but that aren't necessarily the case this year.
Okay. Well, Amy, there are some changes. I don't know if you remember, but it was late in 2012, Congress finally passed a new tax bill and made it very difficult to get some of the items in place. So they did defer some of them till the end of 2013, and that will, hit some people, some it won't. One of the biggest changes was the top earners, and I don't know how many out there will be in this category, but if you make over $400,000 or $450,000 if you're married, your tax rate's going to go up. It is now at 39.6%, which is about a 4% increase. So if you're in that tax bracket, you're going to pay some more taxes. And then also in that same range, if you're above 250 or 300 if you're married, 1,000, then you're going to lose some of your itemized deductions. So even though it's not an increase in your tax rate, you're still going to pay some more taxes on top of that even. And then one of the other increases was in relation to the Affordable Care Act, and that introduced a 3.8% surtax on unearned income for people who make more than $200,000 a year or $250 if you're married and filing joint. Some of the other changes, a little more subtle. This year, the IRS will be taking joint returns for married same-sex couples. Now, we're in Kentucky. That's not the law of the land in our state yet, but there are other people in other states that will be able to file that way now. So that's a significant change. The self-employed individuals, which we have a lot of entrepreneurs in this area, will find it easier to take a home office deduction this year. They actually have a standard rate that you can use of $5 a square foot for the office that's in your home. Instead of having to have your insurance bill, your utilities, mortgage deduction, things like that, if you want to just take a straight $5 per square foot, then you can do that. You still have to have what the IRS considers a home office, a separate room, things like that. There's a lot of things you have to consider to see if you qualify, but if you want to do that, you can go with the standard amount now, and that's a significant change as well. And one of the items that probably hits more people in this area than any of the other is there is now a higher threshold for your medical deductions. And that was 7.5% for the last however many years. But this year it's going to raise to 10%. So what that means is your medical costs have to be above 10% of your adjusted gross income before you start to get taking any deductions. Now, the one group that did not affect is people who are over 65. If you're over 65, you still get to use the 7.5% limitation. So that's some of the most common that'll hit the most people.
So if you are under 65, if your medical expenses have not exceeded a certain amount of money, then you cannot get deductions or include deductions for your medical bills.
That's correct. And a lot of people have been told that you can take medical deductions, and they've come in and they're disappointed when they find that you have to actually get above that limit. There's a lot of misconception out there about that, but that's the way it is. And like I said, they've moved it up 2.5%, so now even more medical deductions are going to be cut out.
That's important to remember. Angie, when people get their taxes done this year and they realize that they owe money either to the state or to the federal government, and especially if they weren't expecting to owe money, how do you talk to them about what to do, especially if they may not have the money to pay?
That's an excellent question, because a lot of people are going to see increased tax bills this year. The Internal Revenue Service has what they call an installment agreement that you can enter into. If you finish your return, you see that you haven't paid in enough throughout the year and you owe X amount of dollars and you can't pay it, you can fill out a form called an installment agreement, and you can send it in. The IRS will review it, and you have to meet certain guidelines. For example, you had to have filed your last 5 years' returns on time. If they look and see that you haven't filed one of the last 5 years' returns, they will reject your installment agreement. You have to pay a fee in order to do that. The fee ranges from $43 to $120.
So you have to pay that fee before you can start making the installments.
Well, they will review your application, and if they accept your installment agreement, they'll send you a notice saying, you need to pay your fee at this time. So if you pay the fee and qualify, you can enter an installment agreement to pay the bill over I believe the maximum is 3 years that you have to pay.
Whatever the amount is that
Whatever
you owe.
the amount
You've
is,
got
yes.
3 years.
I believe you have to have, I believe it's less than $10,000, I think, is what you have to qualify for the installment agreement. But that's much better than simply doing nothing. If you file your return and you see that you owe money and you just don't send the money in, they will hit you with a failure to pay penalty, which can be as much as 25% of the total tax due, plus interest on top of that. So that can really get costly. With the installment agreement, you will still get charged interest, but you won't get charged that failure to pay penalty.
A lot of people won't be expecting to pay, and so that's important to remember, that they do have the option to use the installment plan. But you're right, it's better to pay that than not to pay at all. So don't be hopeless if you owe money. There is some help.
There is.
Well, and one of the common mistakes we see is people just decide, if I can't pay it, I'm not going to file the return. do not do that. At least go ahead and file the return, because then you get a failure to file penalty, which even adds more to your penalty. So if you can't pay, at least make sure you file. We have people come to us after they've missed it happens once or twice. Next thing you know, you're 3 years behind on your tax returns, and you do not want to get in that situation.
That's right, and everyone will eventually have to pay. We're talking with Angie Brown and John Harville this morning about tax season and Mid Mornings with Amy. We'll be right back.